Welcome everybody to the PlantStock channel. My name is Jesse, and tonight we're going to talk about investing philosophies and strategies. Most of us are told to diversify and buy several stocks to limit potential risks and downside. Is this really the best investment advice for 2021? That is going to be part one, and then we're going to focus on if you should invest in the very good food company, aka the very good butchers, or the tattooed chef. And before we get into it, if you want to be part of investing in the plant-based space, want to have the opportunity to gain a lot of profits but still be part of making the planet more sustainable, then subscribe to the channel, as I will keep you updated on the very good food company and the tattooed chef and other plant-based companies. I would also appreciate an early thumbs up, since it will really help the channel grow and reach a larger audience. Thank you guys, I appreciate you. I remember a couple of months back, I met up with a friend of mine who said that he had just gotten to know a new potential friend at the couple's dinner. This guy was a recreational investor and was apparently really keen on talking about his investing. My friend seemed impressed that this guy had many stocks. He found out that he owned like 40 stocks. I started asking my friend about how long had this guy been investing, what was his history like. And pretty soon, my friend started noticing that I was not as impressed about this as he was. I found out that this guy was quite new into investing, yet he owned 40 stocks, and his portfolio was probably worth around $100,000. Not that he had $100,000 in gains, but $100,000 in total, meaning with his own investments. Guys, let me know down in the comments, do you focus on fewer stocks or do you prefer owning many? My first question is then, why does a new investor own 40 different stocks? Like most things in life, you always need to have the why, and that goes for investing as well. Why are you doing this? What is the purpose? For most investors, retail investors, I imagine it is getting more wealth, hopefully trying to gain financial independence of some kind. Depending on your age, most serious investors want to have really good returns on their investments per year. Considering my age and my goals in life, I want an average return on my total investments that are around 30 to 50% per year as a long-term investor. More if possible. And at the moment, especially in the plant-based sector, more is definitely within the realm of possibilities, depending on the company. But in my opinion, owning 40 stocks, or let's just be very general here, owning a lot of stocks will most likely not get you those kinds of gains. And why is that? Well, to make this as simple as possible, let's say you own 40 stocks, and in a perfect situation, 20 of them grow 40% in 1 year. Not very likely in my opinion, but for the sake of the argument, let's say it did. And the other 20 stocks were basically standing still that year, which means they grew 0%. And also imagine that all those stocks are weighted the same in your portfolio. What is your total average in growth? Well, that would be 20%. Then you might say, well, that is pretty good numbers anyhow. And this is true. Depending on your goals, that is pretty decent numbers for your average investor. But realistically, some of those 20 would have probably gone down in worth. And if that is the case, you're not looking at 20% gain, you probably have a lot less. So what am I getting at here? I think you need to look at the stocks that you own as what they truly are, that they are your companies. I think a lot of investors tend to forget that owning stocks in a company basically means that you are a part owner of that company. And if you look at it like that, well, that should probably mean that you want what's best for the company, right? You always want to be on top of things because if your company isn't doing well, then that will indirectly affect you. So doing your due diligence isn't only about looking at the metrics and hoping that the stock will do really well. It is about understanding your company, have an understanding of the industry sector that is part of. And in the case of plant-based food, it's not only understanding the plant-based sector, it is also about understanding the traditional meat and dairy sector. What is their product? Is it a product that people are raving about? What about the competition? Does your company have a clear-cut edge? Who is the CEO? What is his or her background? What is their vision? How well do they execute on their plans, etc.? These are some of the things that should be of interest to you, since this is also your company. This is something that I will go deeper into in future videos. Now, I know it might seem risky to own fewer stocks, companies, that is, but I happen to disagree. And as you know, I'm not a financial advisor. This is just my own personal investment philosophies. Ask yourself, if you are one of those investors that own maybe 10 to 40 different stocks, how can you possibly keep up with them? Even if you don't have a full-time job, how do you keep up with several different industry sectors? Keep up with the latest news, the 10K, the 10Q, the conference calls, and so on. The reality is that most people don't. I actually believe that you limit your risk by owning fewer stocks. In that way, it is a lot easier to keep up with your companies and really feel that you're part of them, which you are, that you are part of their story and their journey. But also remember, we live in an unprecedented time in history in regards to investing, especially as a retail investor. Never before have we been able to access the amount of information at such an ease as we can today with the help of the internet. Traditionally, having your own personal financial advisor made a lot of sense. Yet today, most of us, if we're willing to put in the time, our own due diligence, are able to find a lot of information regarding different companies. By using the internet, I obviously don't mean only look at YouTube. It can definitely be a great start. It could pique your interest and it can give you a better understanding, but it should only be the beginning of your journey into that specific company and stock. Many people believe that having diversification is the best strategy within many sectors. They usually reference Warren Buffett. But by doing that, we have to understand that he is mainly known for being a value investor, not a growth investor. You can't look at companies like Very, Tattooed Chef, Beyond, or let's say Tesla, and focus on value investing metrics, like for instance PE. You can, but just as a small part of it. If you use valuation metrics in companies that are disrupting their industry sectors, it would not make a whole lot of sense. I mean, take a look at Amazon. They have basically been considered overvalued the last 20 years or so, but it is still one of the most successful companies out there, with soon a $2 trillion market cap. And people who have been investing in them over the years, especially long-term investors, have profited like crazy. Also, there seems to be several investors out there who are not aware that Buffett actually doesn't think that investing in that many companies is the best thing. It depends on your current situation and goal. I'll let him explain it himself.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number one just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to, have proper diversification, be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer. Incidentally, I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
In other words, if you feel that you don't have the time to really keep up with your investing or the interest, but you still want to make money, then investing in several companies might be for you. And then, in my opinion, you might as well just invest into an index fund, like an ETF, like for instance S&P 500. Here, you'll still get an average of 8% gains per year, and that is still a really good return depending on your goals, especially considering that you also get dividends. This is also advice that Warren Buffett and several other famous investors has uttered over the years, that for most investors, it makes more sense to just put your money into an ETF. So again, ask yourself, what is your investing goals for 2021? What kind of gains are you looking to find next year and beyond? Would you prefer investing in a fund and let them do the heavy work for you? And if this is the case for you, and you are only or mostly interested in the plant-based companies, there is actually a plant-based fund out there. And if that piques your interest, let me know down below in the comments. Now, how do we apply this knowledge to the Very Good Food Company and the Tattooed Chef? Well, that is what we're going to focus on in my next video, so stay tuned. Guys, that was it for today. I hope you found a lot of value in today's video, and if you did, please smash that like button. And if you want to join the family and keep getting analysis and news on companies like Very and the Chef and other plant-based companies, then make sure you subscribe. And I just want to state again, I'm not a financial advisor. This is just my personal opinions and thoughts, my philosophies. So do with them as you please. I hope to see you soon. Thank you for today. Peace out.